Investors need to be aware that numbers can be deceiving. If a manager promotes himself by saying he has an average annual return of, say, 20%, this tells you very little about actual money in your pocket. To illustrate this principle, we ask you to consider the following question. Would you prefer a 5% average annual return in a fixed investment instrument, or a 20% average annual return in a riskier investment like stocks? Most investors will choose stocks, accepting the higher risk in the portfolio for a much greater return. After all, 20% sounds much better than 5%, right? No, not necessarily. Let's see the results of these two sample portfolios each year to illustrate how risk can affect your bottom line. You can see how the volatility within your portfolio affects results, how a starting portfolio with a 20% annual return can actually lose money. Yes, lose money if the risk is too great. In the end, even with a high annual return, your portfolio has lost 4% from beginning to end. Your starting portfolio of 1,000 has dropped to 960. Not a great result. Now, let's see how the 5% average annual return with low risk does. "20% may sound like a better return than 5%, but in the end, the 5% portfolio has outperformed the 20% portfolio, and by a wide margin. Focusing only on returns without factoring in the effect of portfolio risk can kill your portfolio. The investment industry sells itself to investors using the magic number of average annual returns, but not by showing how much risk can affect these returns is a recipe for disaster. Investors, beware." AECOS, smart investing for intelligent investors.